Good morning, traders and investors and revestors. Let's take a look at the markets this morning. But first, I want to touch on a few things. Yesterday, there was a lot of people actually upset that I didn't mention Moody's downgrade. My comment in general is I'm not a huge fan of news. News is usually anything that moves the market is generally short-term lived. Even if it goes against the trend or with the trend, that move is usually given back. And really, when you think about it, no one really knows what the markets are doing. Banks are supposed to be smart. They go bankrupt. The Fed's supposed to be a genius. They don't know what they're doing. All of this stuff, right? And so people, when I look at the Moody's, it's just a company. It's just somebody's opinion of something. And it doesn't really mean much. It's just noise to me. And everybody's blowing it out of proportion. Yesterday, there was enough comments, emails, and things of people saying the market is going to crash. Today, not only yesterday, but today is going to be another bloodbath. They thought yesterday was going to be a bloodbath. And the markets gap lower. Everybody panicked out in the morning. And the markets end up ripping higher and pushing to new multi-week highs. It just goes to show how people are so tied up with news and headline, and they buy into what everybody says. We can't be gullible and suck into just people's opinions. We just need to follow price and understand the underlying long-term trend, short-term trend, and very short-term trend, and navigate the markets that way. On another note, JP Morgan, Jamie Dimon came out and he's warned investors yesterday against complacency. And we have talked about this. When we look at the 4 stages that the market goes through, which I still believe we are in a stage 3 at this point, if we go down to the market participants' emotions, complacency is what I've been talking about. We've been in for a long time. The market thinks the market's putting in a bottom. They think it's going higher. We're seeing people move into all of the ARK ETFs and Bitcoin and uranium stocks and all kinds of stuff that are really volatile. And that means people are willing to put their money at risk. They're not afraid of losing their shirts. All of those stocks and all of those things people are piling into over the past week, which I showed previously on a video. All of those, they're all going to lose probably 50 to 80 or 90% if we go into a bear market. And this is the complacency stage. People move into highly leveraged, fast-moving things because they think the market's going higher and they want to make 80% or hundreds of percent. They don't realize if it goes the other way, they're going to lose their shirts. And that's what Jamie Dimon and I have been talking about for a long time. We need to be aware the market and the economy is slowing. It takes a long time for things to roll over. When you look at the fundamental data, when you look at the technical data and different assets of where everything's moving, we've had a very strong bounce, which you could say is, I still think is a dead cat bounce at this point. It is a rally. There's no doubt about it. It's a strong rally. I showed previously the rally of the NASDAQ in 2000. The QQQ fell on the first wave down. It fell for like 43%, and then it rallied 63% as the dead cat bounce before falling, 82 or 84%. So these bounces are going to be very strong. And just because it's a strong bounce and rally doesn't mean the bear market is over. Unless the stock market breaks to new all-time highs and we see really good strength across the board. But at this point, we still see all kinds of weak internals. And that's kind of where we are from there. This is just a quick reminder to those of you watching here on YouTube. My YouTube videos are just my analysis. I know a lot of you are saying, where are the signals? Where are the trades? How did you get long? When did you get long? I don't get it. YouTube is, I'm just sharing my analysis. If you guys do want my exact trade alerts, what I trade with my portfolio, the exact symbols, the targets, the stops, my allocations, that is part of my financial newsletter if you want those trades. But the analysis is just to keep you up to speed with the markets, have your expectations set. And if you want to dive in deeper and trade with a large group of investors like myself, you can jump in and join our newsletter and take advantage of the trades and profit like we are in both rising and falling markets, avoid chaos, all of that stuff. So I just wanted to make sure everybody understands that because there's some confusion of where are the trades, when did I get long, and that is the reason why. So let's take a look at the short-term chart, the 30-minute chart here, which is what I like to focus on for short-term momentum and expectations because not a whole lot changes in the grand scheme of things. The market's been in a bounce phase on the daily chart. We're long the markets with our ACS strategy. We've locked in gains, and now we're just letting to see how far it is going to go. We don't really care which way it goes. We just identify a new trend and play that move. But it's nice to look at the short-term charts of what is going on and how to take advantage of things. So just knowing that the market had some FOMO 2 days ago, the market generally wants to reset, and it's usually going to want to flush things out. Now we had Moody's downgrade, and it created a huge gap to the downside. As we know, gaps tend to get filled. So if we take a look at this, if I can draw a line here, we've got this big gap. You can see in the morning, the market opened up, people all bailed and panicked out, and suddenly it was super strong buying volume to the upside and filled that price gap. In fact, if we look at let's go to the SPY, I think, and look at the 10-minute chart. If we just look at the volume yesterday, and I'll just draw a line across here, you can see these first 4 bars, first 4 or 5 bars, the first hour was very, very strong buying. Overall volume for the day was about the same throughout the day, but in the morning it was nothing but buying, and everybody opened up, bailed out right at the open, and then boom, is nothing but people buying up this news. And that is what the news will do to you. You buy into fearful news, it's going to spook you out, and the market's going to go the opposite direction. We got all kinds of weird volatility, all kinds of price spikes on the 10-minute chart, on the 30-minute chart. We can see these spikes. There's increased volatility. We are getting up near the highs. Lots of noise. I'm expecting this market to either pop and extend in a big way or roll over and crash in a big way at any point here. And we have our positions and our stops and everything in place, so it doesn't matter what it does. Ideally, we'll watch it keep going up and pull more money out of the market before it starts to stall out and gives us a trend reversal signal. Now, with a quick shameless plug, if you want to understand the 30-minute charts with the trend analysis, the overbought, oversold conditions, which if we just take a look here and zoom out, you can see the market when we get into, there'll generally be some oversold conditions, overbought conditions. There's FOMO indicators, there's panic selling, tells us when to buy, when to trim, or no, there's a pause, all of these things, along with the trend analysis. If you want to know all this stuff in more detail and get more out of my morning videos, then I highly recommend you do get my book, Technical Trading Mastery. It's generally #1 bestseller in one of many categories. And in that book, I do teach you chapter, I think it's 10. Chapter 10 will teach you trend identification, how I use moving averages and the moving averages that I use. Chapter 11, volatility is your friend. That is going to be the oversold, overbought market conditions, which is when, for example, we get into these lime green, these oversold territories. When the trend is still up, it's an opportunity. The market wants to move higher. Eventually, if a trend changes, it'll get oversold. It'll change its trend. And when you know there's a trend change, there is a sell signal. It'll also indicate when there are these short-term overbought market conditions in the market. Couple that with FOMO buying, where it's overbought to the upside. There's FOMO. You get these very sharp, these are generally very quick pullbacks in the market. And of course, in a rising market, you're really just focusing on panic selling. When there's panic selling, it provides more opportunities to get in on waves of panic. So all of that is in my book, Technical Trading Mastery. And if you go through these chapters, let me see here. Chapter 12 is the volume equals power equals sentiment. This is the FOMO in the panic selling indicator. So all 3 of those things, you can set them up and put them in your charts and follow along and understand what I'm talking about and get a feel for things even more. All right, so let's just jump into what the rest of the markets are doing today. We've got the equities markets trading down about 1/4 to 0.4%, taking a little bit of a breather. Again, they ended up hitting our 100% Fibonacci target here, and now they're just kind of trying to get some traction to break through that. Obviously, we have a ton of resistance up here. Lots of volume through here. And this is kind of right where the trend broke to the downside before. If we take a look at the S&P 500 signal chart, you can see our strategy got us out before the crash. We avoided all of this. We just collected interest. Our account slowly kept going higher as the world fell apart temporarily. And then suddenly the trend kicked back in and we've hit a target and we're continuing to move up. But it is right back into where the trend changed. So it needs to figure out what it is going to do. If it's going to pop and extend and give some blow off phase, which would be great because we are long the markets, or is it going to stall out and and roll over and head lower. It doesn't really matter. The key is we just need to identify trends, protect our capital, and play these moves. And that's the nice thing about what we do is just we follow the markets, and we don't really care about people's opinions and Moody and all that stuff. That's just noise on the charts. It creates blips and dips that are usually wiped back or given away within a session or two, sometimes 3 sessions, depending on how big the news is. Let's just quickly touch on gold. So gold had a nice pop there yesterday. It's up about 0.5% again today, trying to stabilize. At this point, it could be a little baby inverse head and shoulders. It could be a little bear flag before it goes lower. The short-term trend has turned down. It's on a sell short, and we'll see how gold performs over the next little bit. If the stock market does roll over and crash, it will most likely pull gold down with it. We saw this back in 2008. Where gold was a top performer screaming to all-time highs, just like we have right now in the markets. We've had gold screaming to all-time highs as the stock market put in a bit of a double top and had a leg to the downside, double top, leg to the downside, and then it came up and put in this bounce where gold struggled and pulled back, and eventually never really did push up to new highs. Gold ended up pulling back about 34%. As the stock market sold off. So we'll have to see. We're in a phase here. Gold is still a powerful play. It's still holding up very well. But if the stock market does start to roll over and it actually goes for a nosedive, we can very easily see gold pull back with the market here. And we're in this very critical, resistance point on the chart. Last but not least, let's take a look at Bitcoin. We are long Bitcoin. Actually, there's one more. We're going to look at uranium stocks after this. But Bitcoin had a nice push up there yesterday. Today, it is pulling back a little bit. Again, it is doing the same as the equities markets. It moves with the equities pretty much. It's stuck into resistance. If it does get some traction, it could, and this is why I keep saying the stock market and pretty much everything else is ready to have a huge pop or a big sell-off. And we're all protected, and we've locked in gains on all of our positions. We've got break-even stops on the balance, so if it rolls over, we still lock in gains. And we're just waiting to see what this market is going to do. And that's all we can do is play with the underlying trend, which the underlying trend for Bitcoin and the equities market is up. All of the moving averages, which are fanned out and sloping up, are very bullish. These are the exact moving averages I show and teach in my book, and all of that stuff. Last but not least, let's take a look at uranium. We are long uranium stocks. It has been on a tear. It still has a nice little bull flag pattern here. It is set to open higher today. And it might, again, it's on the verge of a pop or a drop. And that's just kind of what we have to, we just have to go with it. Whatever's going to happen, no matter what we want to happen, we don't have any control over it. So again, we're just riding these sectors out. These are top performing sectors based on our hot list. If you look what the top performers are, blockchain, the ARK ETF, Bitcoin, semiconductors, uranium, technology, TAN, clean energy, hail. These are all the things that moved the most during COVID, the bubble, when everything took off. These are all the aggressive stocks. And this is a complacency move. People are piling into these things, thinking that we're starting a bull market. And I'm getting a ton of feedback of how wrong I am and how a bull market has started, and this is a major bottom and all of that stuff. And to me, it's a great indicator that people are getting sucked in, and we're getting closer to a market top. And it doesn't matter if we are, or I am right or wrong, if we are not in a bear market and the market takes off and things continue to rip higher. Well, if we get lots of strong conditions, then we'll kick back into a fresh stage 2 and the market will go up. But there's a lot that has to happen for it to be a full-fledged stage 2 bull market. Just because the market's going up, it has strong rally. And even if it pokes to nominal new highs, doesn't mean the market is in a new full-on bull market. If we go back and just look at the indices from in the past, let's go back and take a look. Here we can see the stock market had its big move down. It had a bounce back up. It poked to nominal new highs, got everybody crazy complacent and bullish. And then, of course, boom, it had a leg down. It had a big bounce, and it went into a multiple wave. So for all we know, we could have just had this first big sell-off in the stock market, and maybe we come up and pierce to new all-time highs, and then we go into a bigger pullback and correction. It's hard to tell where we are. I believe we're somewhere in this space, which again is that stage 3 topping phase when we go back here. We're somewhere in here, and the key is to protect our capital. Anyway, that's it for now. Talk to you soon. Bye-bye.